Hey everybody, my name is Michael Lafata, and welcome to the Sharpe Minds podcast. On this podcast, we have interesting conversations and we hear high-level insights from world-class guests. On the show, we're bringing together the vast world of finance, financial planning, and wealth management. Tune in frequently for uploads to YouTube, Spotify, and Apple Podcasts, in addition to following us on social media, which will be linked in the description. Fortunately today, I was able to sit down with Kevin Flanagan of WisdomTree. Kevin is a part of WisdomTree's investment strategy group, and Kevin is the head of fixed income strategy for WisdomTree. During our discussion today, we touched on three main topics: the macro environment, the current state of interest rates and where they might be headed, and the role of fixed income in your portfolio. Without further ado, I hope you enjoy my conversation with Kevin Flanagan as much as I did. Well, Kevin, I greatly appreciate you taking the time to spend with us today.
Thanks for having me. I appreciate it.
Of course. So I do want to give you a quick intro. This is your first time being on the show, so would love to give you a quick introduction. Kevin, you're part of the investment strategy group at WisdomTree. You're also the head of their fixed income strategy. Within this role, you contribute to the asset allocation team. You write fixed income related content, and you travel with the sales team, conducting client-facing meetings and providing expertise on WisdomTree's existing and future bond ETFs. Prior to joining WisdomTree, you spent 30 years at Morgan Stanley, where you were managing director and chief fixed income strategist for their wealth management division. You contributed to the Morgan Stanley Wealth Management Global Investment Committee. You were the primary author of Morgan Stanley Wealth Management's monthly and weekly fixed income publications, and collaborated with the firm's research and consulting group division to build ETFs and fund manager asset allocation strategy models. Prior to all that, you received your MBA from Pace University and your finance degree from Fairfield. So quite the resume, and it's fantastic to have you and hear what you have to say today.
Looking forward to it. Let's rock and roll.
Yes, sir. All right. So as you know, it's been quite the year for fixed income. Actually, quite the few years. And not just that. The macro environment has been extremely interesting, complex. As well. So, would love to hear your overall thoughts on the macro environment. It seems to me like macro is tied closer into how fixed income performs. I'm not sure if you share that same viewpoint. Equities obviously have a larger emotional attachment to them. But fixed income, it's more math based. And really sort of grounded in the economy and sort of the macro environment. So would love to hear your initial viewpoints on that.
Yeah, us bun guys like to think interest rates is what makes the world go round, right? And I think you're spot on when you're looking at interest rates. What do you focus on? Well, you focus on the macro. What's the economic backdrop and outlook? What about inflation? Fed policy? We just recently had an important kind of decision in November. I'm sure everybody is familiar with the election. Fiscal policy also plays a role as well, budget deficit, supply, but really it all begins with the macro. Economic data, specifically labor market reports, inflation, and then how does the Fed respond? And I think that's what you've seen really underscored over the last couple of years.
Yep. So let's talk about jobs for a second. We've had for the past couple of years, right, past the pandemic, it seems like people couldn't hire people quick enough, and honestly, there weren't enough people to fill all the job openings that we had, and then during the summer of this year, it was really interesting because we had a quick uptick in unemployment claims or jobless claims, and that seems to have sputtered off a little bit over the past couple months. So what are your viewpoints on the jobs market, and what do you think might be going on there?
Yeah, I mean, jobless claims, it's a great reference. In my opinion, it's a key economic indicator to watch. Oftentimes I get asked, Flanagan, what economic numbers should we watch? And of course, the monthly employment report, CPI, you could run through the litany, but I think it does start perhaps with jobless claims. It is one of the 10 leading economic indicators. And if you go back over the last 40 years or so, it did serve as a harbinger for a recession. However, the level of claims during that 40-year period before each of these recessions was about 100,000 higher than where it is right now. So that's why when you're looking at the broader outlook for the economy at this stage of the game, I think, the focus is if the labor market remains resilient, if the labor market does not show signs of too much cooling, then the economic backdrop itself should continue to stay in a positive real GDP territory. And that's been playing out here. So I think that's an important part of the puzzle. Like, we began the segment by asking, what does the bond market, primary drivers of bond market, and we spoke macro. Well, within the macro, it does begin with the jobs numbers, whether it is claims or the actual monthly report itself. And you will get some, volatility month to month. That happens in the data. You need to smooth it out. And that's what we try to do when we're looking at non-farm payrolls is, focus on 3-month moving averages. And I think that provides a better trend of what the underlying condition is for the labor markets in general. And it's not just me saying it or some other bond market talking head saying it. It's part of the Fed's dual mandate, right? That
Yep.
the Fed's dual mandate is employment and inflation. And I think what we've seen with respect to the Fed, after showing more of their concern on the inflation side, especially when they were raising rates 500, 525 basis points, is
Yep.
they shifted back to their dual mandate, which is why we got a 50 basis point rate cut in September, because the jobs numbers were beginning to show perhaps that there was something more going on, that it was cooling more than anticipated. Since then, obviously, we know now in hindsight that that cooling was not as cold as we thought. And of course, the last jobs numbers we got, unfortunately, they were hurricane related and strike related, and we should see some bounce back now as we move forward. So I think the Fed will get a cleaner picture over the next couple of months of just how much, if any, cooling in the labor markets has taken place as we head into 2025.
Gotcha. And do you think that that's something they're paying closer attention to rather than, I know they like to pay attention to the PCE number rather than, CPI. Do you think they're paying closer attention to the jobs, or do you think they're kind of weighing, both the inflation, right now and the job market softening?
Unfortunately for the Fed and the changing perceptions in the money and bond markets, is what we've seen on that front, both labor market and inflation. So, taking out the hurricane and strike related numbers from last month, as I mentioned before, it didn't look like the employment setting was cooling as much as anticipated. And then at the same time, we've hit a couple of roadblocks on the inflation numbers, whether it is, to your point, the PCE deflator or the consumer price index, where you actually saw unchanged readings, or if not ticking up a little bit year over year. Now, Powell described this inflation development over the last few months as what he sees as being a bumpy path. I don't disagree with that. I think we saw that earlier in the year. We had a bumpy path before um, disinflation took hold again. But you are wondering, right? I mean, far be it from me. I've never run a marathon. I've been told the last mile is the most difficult, right? And I think we've heard that analogy a lot. And I think that is what we're seeing with inflation, that last mile, if in fact we get to the Fed's 2% threshold, which is another debate, is probably going to be difficult, more bumpy, and that you know the Fed. This is one of the higher core CPI readings year over year. We've had to begin a rate cut cycle in quite some time. So the Fed is, I think, weighing both. I think they thought maybe they had a free pass on inflation, that it would kind of continue to move in the direction it was over the summertime and then focus on the labor markets. But the last couple of inflation numbers, I think, threw some wrench in the works for the Fed. So I still think they're focused more on the labor markets, which is why I think they'll probably cut rates one more time this year, and then perhaps take a pause and look at things in 2025. But also saying, oh, thought we had it going here on the inflation side, but we need to don't take our eye off that ball. So I think that's where they're at.
Gotcha. So going into, so we'll get one more cut this year. You're thinking, and according to Fed Watch, the market's pricing in about a 66% chance of 25 basis points this month getting cut. But going into next year, they're expecting, I think the number is somewhere in the ballpark of, 5 quarter basis point cuts or something like that. And if we don't get that, to me, that's something that could easily, stall out not just the stock rally or stock market rally that we've seen, but it could just have an impact, all around the markets on the fixed income side as well. Just because if we don't get those 5 cuts, I just don't think the market's going to like that at all. And so, would love to hear your thoughts on that.
Yeah, so I think the markets have come. I would argue to a little bit more of a reality,
Mm-hmm.
so that those 5, 6, at one point it was 8 rate cuts.
Yeah.
Have been dialed back now to maybe 3, maybe 4, somewhere around there. But that could be including December as well. So maybe just a couple more for 2025. And interestingly, we'll find out soon enough with the December Fed meeting, because we do get the dot plots and the summary of economic projections, what the Fed's thought. Remember, when we got it in September, the Fed was thinking 3.4%. So, if you do the math and they give you a quarter point in a couple of weeks, that takes the Fed funds rate, to 4.25, 4.5. So let's just, say 4.40. So that would still be 4 more rate cuts for next year. The Fed may be making some adjustments on that as well. And so both the market and the Fed perhaps are marking to market with their outlook for what may be coming. And that's what happens when you're in a data-dependent world, a highly data-dependent world. And in that highly data-dependent monetary policy world, that means the bond market, by extension, is also in a highly data-dependent world, which is why we've seen such wide swings in yield going back to October of last year. If you look at over the last year, we've had declines of 100 basis points, retracing 70-75% of that to the upside, another rally. And then if you look at what's occurred since mid-September, you have a whole nother narrative. And I think that's what happens when the Treasury market is perhaps the greatest discounting mechanism on the planet in terms of the financial markets, but you need validation. And if you don't get validation, this is what happens, so that you can discount what you believe is going to happen. But if it doesn't get validated, then you got to reverse course. And that's exactly what's been transpiring in the Treasury market over the last year or so. And in a data-dependent world, unfortunately, it begets volatility. And I don't think that volatility is going to go away.
Yeah, no, that's a super interesting point. And certainly want to dive into, the current, landscape for fixed income and what, we expect going forward. But real quick, before we jump there, just would love to hear, some thoughts on inflation real quick. 'Cause, I know Professor Siegel has been going on for a while about how, if you actually, track, rents at real time, and some other factors that, it seems like inflation, it might have changed in the past print or two. But at least initially this year, it seems like inflation was actually at one point negative year over year or flat. And large part of that is because, rents within the CPI and other shelter components they have a lagging effect to them. So if you get real time data for those, they have that has a huge effect on what that CPI print actually looks like.
Yeah, so I mean, there's a couple ways of looking at it. I don't disagree with the professor that um, a lot of different economic indicators that we get on a regular basis, are going to have its pros and cons to it for sure. That you can dig in and find out where it's understating or overstating, and inflation was certainly one of those categories with respect to shelter. But for the bond market, what the bond market will respond to is the actual number. So, just for argument's sake, if you were to get, say, core CPI, and when we get it in a couple of weeks, I think it's a couple of weeks. I mean, say the year over year rate rises back to like 3.5%. Now, is the bond market going to sit back and go, no, 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 no? They're over measuring shelter here. That they're overshooting shelter. It's really not that high. Or would the bond market sell off on that? And it's kind of a rhetorical question, but I think the answer is the bond market would sell off. They're going to focus on the actual numbers that the BLS, the BEA, whoever it is, are releasing. I mean, you and I could sit back and have a nice lobster bake dinner or something like that up in Boston and discuss whether we think the number's accurate or not. But the bond market isn't going to debate that. It's going to respond to the actual number that comes out more frequently than not at 8:30 a.m. Eastern time.
Yep. Okay. That's that's a great and interesting point. Um, all right. So something that we touched on a little bit. Let's discuss the current state of fixed income. You touched on that you think this is sort of a normalized environment for bond yields. I totally agree personally. But the interesting thing that I've seen recently is just if we look at the recent drawdowns within, just using the ag for example, currently we're at 52 months of being of being at a drawdown, with the max drawdown during that period of being about 17%. So that's, to me, that's extremely interesting. But then if you look at it from the point of, okay, well, I can buy a bond today that's yielding 4.5. At one point, you were getting maybe 5%. It just doesn't seem at all like this is a bad time to enter the bond market, and it's the value proposition right now for bonds is fantastic because the yields are great. So what do you think about current state of yields, and do you think that this is the new normal that we're going to continue to experience?
I would say it's the old new normal, right?
Yep.
From 2010 to 2021, to me that was abnormal. You had zero interest rates, massive quantitative easing on a global scale. You had negative interest rates in Europe and other places. You were dealing with at one point a 10-year treasury yield between 50 or 55 basis points, high yield at 4%. That's abnormal. If you look at the course of bond market history, what you're seeing now is more akin to what was occurring in the period leading up to, say, the financial crisis, which is
Right.
really when this began. So I would say, we would talk about it as a theme at WisdomTree as the new rate regime, but it really is the old new rate regime. And what's interesting about it is that you had a whole generation of investors, financial advisors, let's call them market participants, who had never experienced rates where they are right now. And if you go back to just look at Fed funds, okay? So Fed funds, when they began this rate cut cycle, was at its highest level, I think, since the early 2000s, right? So let's just call it almost 20 years ago. So for everyone out there listening, ask yourself the question, what were you doing? How old were you 20 years ago? Me, being a quote unquote seasoned bond veteran, I know exactly what I was doing. But for a lot of people, they've never experienced interest rates at these type of levels before. What were they used to? Well, they were used to the Fed raising rates in 2018 up to two and a quarter, two and a half, and that being the peak. And then the Fed cutting rates, and even before COVID, where you would see rates come down where it's like, well, where the 10-year going to be? Well, maybe it's going to one and a half, one and three quarters, because that's, Fed funds could be heading down to that kind of an area as well. And curve being relatively flat and whatnot. But I think that my point being is that was the expectation for what I think was the abnormal rate regime. Whereas now, part of the problem when the Fed raised rates and you saw bond yields, really spike up here, is that people finally capitulated and we're like, no, rates are not going back to the way they used to be. And the Fed is been publicly admitting that even with this rate cut cycle, right? What I mentioned before, the dot plot 3.4. Well, that's still 100 basis points above the peak of the prior rate hike cycle, right? The peak of this rate hike cycle was 300 basis points over what was the case in 2018. So I think investors need to kind of acclimate themselves towards this rate environment for those that never experienced it before. So if you hadn't experienced before, then you're not so sure on how do you position your overall portfolio, let alone your bond portfolio, because it's going to impact, what you're putting in equities, cash, alts, you name it, right?
Yep.
So
Yep.
I think it's been this kind of ongoing decision-making process for advisors, for their clients, on how do we now incorporate fixed income and finding out that it's a lot different than was the case in the pre-COVID days. And I think that's why you've had this great discussion over the last couple of years where, I remember I'd go into an advisor's office and they would say, hey, this guy just came in telling me I had to go long duration. I mean, right? How many times have we heard that? And that harkens back to what I was saying before, that just because the 10-year goes to 4%, it's like we should go long duration here because it's going to fall to 2.5 or 3. It doesn't work that way. And I think that's what we're finding out. And unfortunately, like you were mentioning or harkening on the ag, a lot of people have learned the lesson the hard way that, okay, we may get this volatility that I mentioned before, but you also get this snapback, and it's not a one-way street anymore in the bond market. And I think that's something investors need to get used to. But more importantly, it represents opportunity for the bond market, for the fixed income investor, of where you could be looking now. I mean, one of the areas that has been one of our high conviction ideas has been Treasury floating rate notes. And people say, wait a minute, Flanagan, what are you talking about? Floating rate notes are for rising rates. No, not really. If you look at Treasury floating rate notes, which are backed by the full faith and credit of the U.S. government, they're tied to the 3-month weekly T-bill auction, which is essentially Fed funds, right, with an accompanying spread. Right. So that when you have an inverted yield curve, which is what you do have, 3-month T-bill versus the 10-year, then why would you consider, say, buying a 10-year at, let's call it 420, what I'm seeing on the screen today, versus something for the Treasury floating rate now, which is 460? So you're still 40 basis points above. You're still almost 2 rate cuts above just to be flat with the 10-year without the volatility, without the duration risk. So I think that's one example of what we're talking about with clients on how to position themselves for, let's call it, this new old rate regime.
Yep. Gotcha. Very interesting. So, if we look at just flows into, fixed income, products this year, from what I've seen, there's been so much money going into, into those longer duration products. What would need to happen in your from your point of view, for those investors, to start to see some return on their money, right? Because like I pointed out, the ag's been negative 52 months in a row. You're getting paid more. to sit on the shorter end of the curve right now. What would you like to see for to start saying, okay, it's time to start taking some more duration risk, and how do you think that would play out?
Well, I think the one way you can mitigate some of that risk, and once again, this is our high conviction idea, is to implement a barbell strategy.
Yep.
You implement something more core duration like, which say a treasury floating rate strategy. To me, that is what makes sense in the environment we're in and will most likely continue to be in as we go into the new year. What would you need to see? So I think that's a great question. Sometimes the answer is simple and staring right in front of you, right? So if you're sitting here right now with a 10-year, I just alluded to, is around 420, 419 if I look on my screen to be precise. If you're going to go long duration at 419, what is your underlying assumption? Well, your underlying assumption would be more than likely to have it make sense. You think you're going to 3.5, maybe you're even lower on the 10-year. And I think if as an investor or an advisor, you look at it that way, I think it helps in the process of rather trying to put your chip on red or your chip on black where you think rates are going to go. Just think about it that way. So, okay, what would get the 10-year to three? Let's call it 3.25. Let's split the difference. Let's say almost 100 basis point move here. What would get the 10-year treasury there? Well, it's full circle, Michael, what we were just talking about, the macro.
Yep.
You would need to see that labor market data getting cold. You would need to see disinflation back in track, and you would need to see the Fed going back to where we were around mid-September when Fed funds futures were pricing in, 8 more rate cuts and a Fed funds rate at 2.8%. So that's the way that I would look at it. That is not my base call right now. I think we're going to be more in a range bound pattern, which is why the barbell makes sense in that environment. And
Yep.
the barbell would make sense if that were to occur as well, because you could still be, mitigating that risk potentially with duration if you're wrong with the floating rate aspect. But if you're right, you can participate in a rally. So it's a way of, like I said, not putting your chip on red, not putting your chip on black. Fixed income, I mean, let the equity market be that. Let the fixed income part be more of the ballast for your portfolio.
What it's supposed to be, right?
Yeah.
No, that's interesting because recency bias is a really interesting thing. Because to something you mentioned earlier, right? We haven't had normalized rates, so to speak, since the GFC. And that really caused this low rate environment. And there's been no need for some sort of barbell strategy within the fixed income side. And frankly, you haven't had the chance to really do that, up until recently. But on the equity side, you see it everywhere, right? All the time, you hear people saying, "Oh, I recommend value and growth barbell, barbell, large and small, whatever it might be." So it's interesting to hear that concept on the fixed income side as well, and it's fantastic that we actually have the opportunity within the markets today to even be in a position to implement a strategy like that.
Well, I love it when the equity crowd wants to mirror something that the bond market crowd is doing, right? So
Right.
we started the barbell strategy. Let them come on and join the party. That's fine. Before you know it, who knows? Maybe they'll start talking about laddering in the equity markets also. But that's all kidding aside. You're right. It offers investors just a whole new reference
Right.
on how to make their decisions going forward, and it's holistic. It's not just looking at bonds because that's going to affect the stock part. And with rates still and cash being 4.5, 4.75, that still plays a role as well, right? I mean, that was potentially one of the main causes of what was occurring when we had the regional bank trouble. What was that, year and a half ago or something like that? Was
Yep.
the fact that people could move their money into money market rates where they could get 5.25%, 5.5%. So it all impacts each other without a doubt. And we're still there. As I said, we're still there. So let's just say, for argument's sake, that the Fed cuts rates in December. So that brings the target rate, if it's 25, to 4.25, 4.5.
Yep.
And say they sit back and they pause for a while. Well, what are money market rates going to be? What are Treasury floating rate notes? Treasury floating rate notes will be money market plus something more than likely. Then what is your incentive for moving too far out on the curve? I would say very little. That's why I wouldn't go long duration. I would look more to core duration if you want to start, you know, incremental moves out on the maturity spectrum on the curve itself. That's the way that I would look at it at this stage of the game. And I don't see that changing, like I said, unless you show me the next couple of employment reports that it wasn't hurricane or strike related, what we saw before. Then you have a different ball game. But as of now, that doesn't look like it's going to be the case.
Right. Right. Is there an opportunity cost in money market account or money markets right now? Um, obviously, if you compare it to the equity side, you can argue that there has been, right? Because you have S&P up, you know, 25+% this year, um, but we haven't really seen that on the fixed income side yet. Is 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 there some sort of opportunity cost there, or thought of phrased another way, maybe like reinvestment risk, something like that.
Sure. I mean, just sitting in a money market, clipping, let's say for argument's sake, somewhere between 450, 475 now. And if the stock market continues to perform as you've seen it, yeah, I mean, from a total return performance perspective, there is an opportunity cost for that. But then you're asking yourself the question, why am I sitting in, say, 450 or 460 money market? It's an offset, right? So that, you're not 100% invested in the equity arena. You want to have some kind of offset to that just in case. So whether it's in the money market, whether it's in the bond market, whether it's the money and bond markets, there's that offset. I know, we run models that we work with Professor, you mentioned before, Dr. Siegel on, we're more of a 75-25 mix, 75 equity and 25 the other part of the portfolio. Perhaps that's the solution so that you can try to minimize some of that opportunity cost if that's what you're concerned about.
Gotcha. Awesome. All right. So something that so when we think about how rates are still elevated, but the Fed has started to cut rates, something that I don't think gets really talked about enough, and this ties into the macro environment. In my opinion, this ties into the macro environment, just like we've touched on, is you've seen the Fed funds rate come down. They've cut by 75 basis points so far, and we're expecting another quarter cut. But the 10-year's gone up since the initial cut in September. For people that might not fully understand why that is, right? You have one interest rate going down, but the other going up, and you would assume that maybe they're tied to each other in some way. Can you just touch on why the 10-year has seen that rise, and how it's not totally correlated to what the Fed funds rate does?
Yeah, I think it's a perfect example and a great observation of how not all rates are going to move in the same direction and or magnitude, and why, right? That's your question, why? But it's degrees of separation. Fed funds is based on overnight money in America. Okay. So what's your duration there? Essentially zero. What's your maturity? Essentially zero overnight. And when you think about it, as you move further out on the yield curve, you just by, pure design, you take on more potential risk because you're moving the maturity date out, right? So that adds the first layer of uncertainty. If you're lending somebody money and they're borrowing it just for overnight, you're like, okay, fine. Say you and I, lend each other money. I'm going to pay you back tomorrow, Michael. Great. I'm going to pay you back 10 years from now, Michael. Wait a minute. maybe I want a little bit more of an interest rate to charge you because I'm taking on that risk. I don't know, Kevin, where you're going to be 10 years from now, what you're going to be doing, how credit worthy are you going to be 10 years from now to pay me back? So I think that starts the, you know, explanation. And then also, what comes during that time frame, right? What's more impacted? The further you go out on the curve, the more of those degrees of separation there are, and you're going to see more of an impact from duration. You said it before, mathematics, right? Bonds being mathematical kind of formula that you're going to be looking at the economic numbers, the job numbers, the inflation numbers, how they come in and respond accordingly. So you just keep layering more areas of that uncertainty, and to use the term again, adding more degrees of separation for something that overnight you could argue, hey, there hopefully there's not going to be a development overnight, right? That creates a problem. But the
Right.
further out you go, there's more uncertainty. And that's why. And that's exactly what you've seen here. And that's why I go back to Treasury floating rate notes being tied to something like the weekly 3-month T-bill auction, which is going to be tied more directly to the actual Fed funds rate, not what you think it's going to be, but what it is. And that is a major difference from where you see a 10-year, because a 10-year is basing its pricing mechanism on what that instrument feels the situation is going to be like. As I mentioned earlier, that discounting mechanism. And if it's not validated, then you could have that rate actually go up or move sideways while the Fed's actually cutting overnight rates.
Right. Gotcha. Gotcha. So yeah, it's all, if there's, fear that the economy is going to slow down, if there's fear that, the consumer is not going to be in as great of a spot, sometime from now, all those things, they certainly have an effect on what that 10-year does.
Yeah.
All right. So, and, speaking about that, that, blends itself perfectly into, sort of this pathway that I wanted to go down, which would be sort of how some of the things that the new administration might, some of the policies that they might implement, how that could tie directly into, inflation, the consumer, and in the end, what we're talking about directly for the fixed income market. One of the things that President-elect Trump has talked a lot about is tariffs. He hasn't done anything specific yet, and obviously he can't, until early next year. But recently, according to the Wall Street Journal, he recently said he's going to implement a 10% tariff on China, 25% on Canada and Mexico. And the interesting thing is those three countries combined, their imported goods account for about 45% of the imports to the U.S. Through just this September, right? And that's per the Wall Street Journal. If we see those tariffs, if we see some more onshoring, right, taking more production back into the United States, initially that's going to have a big inflationary effect. Presumably, that's the outlook. What's the potential, for a lot of this stuff, having a negative effect on fixed income, right? Is some of that stuff priced in to maybe why the 10-year has been rising recently? Would love to hear your thoughts around that.
Yeah. So, I mean, everyone talked, post-election, the Trump trade quickly faded, didn't it?
It did, yeah.
So, I mean, right. I mean, you could say, well, why did the bond market trade off, recently? And some would say, well, it's the Trump trade. It's the red sweep. So, you'll be able to get legislation through, deficit spending will go up, supply will go up, tariffs, inflation. The bottom line from the supply side, from the deficit and supply side, you need to take that out of the equation. Whether it was a blue sweep, red sweep, or neither sweep, you're still running baseline deficits of about $2 trillion. So to me, I remove that part from the fiscal aspect of things. And looking at it from a tariff perspective, if you go back to January 2016 to right before COVID, and you look at core PCE and core CPI, they were only up about 0.2% year over year. So I know the tariffs that are being mentioned now are larger in size and scope, but we do have, some history we can go back to. So did inflation go up? Yeah, but just barely. Okay.
Right.
Now, China seems more of the low hanging fruit because it's probably the one thing both sides of the aisle can agree on at this stage of the game. Canada and Mexico, when you dig in a little bit deeper, it seems as if the president-elect is focusing on using tariffs as sort of that carrot stick approach, right? That he wants to get something out of both sides of the border that he wants. And in order to get that, he's threatening things on the tariff side. So we'll wait and see what happens on that. If he can get, say, the fentanyl, the border crossings, if he can get what he wants out of that from Canada, from Mexico, then odds would favor you're not going to get 25% tariffs. So it would be something that perhaps we're getting all worked up about, that maybe we should just wait and see. And that's what I think the bond market would ultimately do as well, that you need to see it in the data. And interestingly, Powell's press conference in November, remember, that happened right after Election Day, and he has mentioned it since then, that the Fed's not going to be basing their policy decisions on what could happen, what legislation could pass. They'll want to see what's passed and then see how it does impact the numbers coming in. Now, some could argue, hey, well, that gets you behind the curve, but it's an uncertainty, an unknown that's out there that, sure, you have to watch, but you're better off seeing how it's implemented and how it's impacting the market. I mean, the data, before you actually do something, say from a monetary policy perspective. So I think that's where we're at right now. I think everybody's kind of waiting and seeing what goes on, and then his economics team, who he's putting together, are they as gung-ho on the tariff thing? Could they soften things up a bit? We'll have to see how it plays out. So I think it's an interesting question. It's an interesting observation, something that the market is certainly looking at. Probably equity and bond market, but I think in terms of an impact in the near term, I really don't see that occurring until we start seeing it show up more in the data. Now, that being said, say January 21st, when President-elect officially takes office, the next day he implements the kind of tariffs you just mentioned, then you're talking that's a different ballgame. That's a different ballgame right there.
Right.
So, better to wait and see than try to, I think, prepare for what you really don't know what's going to happen.
Right. And part of it's just, him doing his thing, right? The other day he joked about putting 100% tariff on the BRICS countries if they threaten to replace the US dollar. That just wouldn't go over well with our markets and with the consumer. So part of it's just looking through some of the stuff that's being said. And to your point, and something that I find extremely interesting is, it seems like the market is kind of observing his cabinet picks as it's kind of suggesting lower policy risk for the markets. Two that stood out to me are, the Treasury Secretary of Scott Bessent, who we just picked, and the Secretary of Commerce of Howard Lutnick. It's extremely interesting because, they run two prominent firms on Wall Street, and they have, an extensive background, in the world of finance. So I think that's extremely interesting that you pointed that out, and I would adhere to that thought that, with guys like that as part of the cabinet, right, the markets could certainly be at lower risk of experiencing some of these issues, And some of the stuff that he might say, he has people in his ear basically telling him, hey, markets might not like that, right? Or they'll say it another way, but that's the message.
Yeah, like I said, if, first everyone needs to be confirmed by the Senate, get into the posts, and then we'll see how it plays out from there, right? How much pushback will he get from some of his appointees? And the one area that still won't be impacted will be the Fed, which is interesting. The mere fact Powell actually went that way during his November press conference and said he's not going anywhere till May 2026, spoke volumes. So we have to wait and see on the fiscal side. We just don't know. We know some things that were out there, but what actually gets implemented? Perfect example is just from the legislative side of things, right? That you're going to have a razor thin majority in the Senate, a workable majority, in the House, a workable majority in the Senate. But, is any kind of major legislation going to get done in the first 6, 9 months?
Right.
Arguably, probably not. Once you determine what's the low hanging fruit, you re up on the Tax Cut and Jobs Act, you go make some changes to the SALT deductions. That's probably where we're going to go. And what's the offset? Will there be offsets to this? Will Eline and Vivek get involved in the conversation and say, hey, maybe there's areas we can cut on the spending side here as well. So, like I said, once again, I think we're kind of in a wait and see. We know what was mentioned um, on the trail leading up to the election. We can see some of the picks that are being chosen. But once again, I'm gonna be probably more Powell like here,
Yep.
and kind of wait a little bit before I make a high conviction trade in the bond market. Um, that you should do something accordingly, which gets back to the barbell strategy. See, that's the second time we've come full circle now.
That's awesome. That's what we want to do, right? That's couldn't do it any better than that. All right, so another thing that I've been thinking of, is how the current interest rates are affecting corporate earnings and and their investment strategies. Um, we've had um, not the most favorable environment for mergers. That might reverse next year and for the years to come. And then on top of that, you have companies that can earn 4.5%, 5% on their money.
Well, that gets a little bit out of my wheelhouse. Talking about earnings, what I will say, focusing or turning it into investment grade or high yield credit here in the U.S., that there's been a lot of pushback and some concern that spreads are too tight. I
Yep.
wouldn't necessarily disagree with that, but we have seen spreads at tights similar to this in the past, especially before the financial crisis. And that in an economic environment where the economy is growing 2.5%, inflation is it's not really heating up, you've had periods where spreads can stay in this kind of lower range bound pattern going forward, that you would need some kind of catalyst to knock you out of that. So for me, that would be a way that I would transition that in that kind of an environment for investment grade or high yield. Okay, what are you going to be using your cash for? Um, and in the environment we're in now, it seems like you could be perhaps a little bit more aggressive than rather just being servicing your debt, and your cash flow seems to be good from that vantage point. So that's the first part of the equation: service the debt. Then what do you have left over? Where can you go from there? And I think that's one of the reasons why spreads, especially for high yield, are sitting, you know, what, like 270 basis points right now, which, we talked about a normal rate setting. What's interesting, if you do a bar chart that I've done before and show, like, 1988 to 2000 or 2005 or something like that, before the financial crisis, and you just scope out treasury yields, US investment grade, and US high yield, and then you do the 2010 to 2020 period, and where we are now, treasuries and investment grade corporates don't look all that dissimilar to that 1988 to pre-financial crisis period. High yield was getting back to that level, but with spreads coming in so much, it's interesting that you're not seeing that same degree. You're talking about what on the index, a little over 7%. We were more 8 or 9%, not too long ago on that.
Yep.
So you've had some definitive improvement and rates actually coming down there to some extent because of spreads tightening so much over the last year or so.
Do you see a role for high yield in portfolios at the moment? Whether it be like a model portfolio or just standard client portfolio. How are you thinking about the current positioning for high yield?
Well, I mean, typically you would see high yield as your plus and your core plus component, right?
Right.
So the question is, what do you want to use for your plus? Are there other areas that you could focus on? Agency MBS could be one. In the securitized space, maybe that's an alternative you want to take a look at, just from a relative value perspective. Are the yields comparable? No, not necessarily, but performance is also something. How much is priced in versus not priced in? A lot of goods priced into high yield right now, right? I think most people would tend to agree with that.
Right.
Where, last I checked, you still had agency MBS spreads being wider than their 10-year mean. Same goes with investment grade kind of credit, that they're on the lower end of their 10-year median level. So, there's other options I think you can look at. We launched, about 3.5 years ago, an alt credit strategy where you can access private credit in there. Maybe you want to go down that route where, you're seeing yields in the area of 11-12% versus 7%. So there's other options I think you can take rather than high yield from a relative value perspective. And it all comes down to, what is your risk parameters? How you want to play this on the bond side of the ledger. What is going to be more, correlated to, say, stocks? Well, you would tend to argue probably high yield. So maybe you do want to look in the MBS space. Maybe alt credit is something that you want to look at a little bit as well. So a lot of different things I think to take into consideration, but a long-winded way of saying high yield of what I just mentioned is probably the lower end of the relative value trade.
Do you buy into the idea that high yield should have more of an equity like positioning within a portfolio rather than a fixed income positioning?
I think when spreads are tight and yields are low, it makes more sense. When you had yields 8% or so, then you have a cushion
Right.
where you can see perhaps a little bit of a less of a one-for-one kind of a correlation aspect that a lot of people argue high yield can have, because that 8% yield provides you cushion if spreads do widen out, or if you were to see, obviously, in that case, high yield selling off. And more likely than not, if high yield is selling off, you could probably, it wouldn't be a leap of faith to think that the equity market isn't going straight up anymore as well. So I would say here, with spreads being where they are, with absolute yields being where they are, there really, I don't think, is much margin or room for error on that side when you're looking at it as compared to the equity component of your portfolio.
Yep. And something that could cause that error would be something as simple as a consumer slowing down, right? Something like that could make high yield, could make yields for high yield, go higher, and might not end well. All right. So, that's also interesting, and something that that would I want to finish up here with is sort of the outlook going forward. Um, I mentioned before, right? The value proposition for bonds right now is all in that yield, and it's fantastic. Um, how do you view how bonds might do next year, how fixed income might perform next year? Um, what economic indicators should we pay high attention to, which could have a huge effect on the bond market? Just if you could just elaborate on some of that, that'd be awesome.
Yeah, so once again, it is Groundhog Day. I know often used term these days. Not seeing any signs that the economy is going to finally buckle and move into a recession. So moderate kind of growth going forward. Let's say a two handle on real GDP. I
Yep.
think the road on inflation will continue to be bumpy. I'm not convinced you'll get to the Fed's target of 2%. I look at it from core PCE, which I think is 2.8 right now.
Yep.
I think the Fed will still tilt policy or skew it towards cutting rates, but maybe just a couple more. And when you say a couple more, does that include December? No, I mean, maybe they do one or two next year. But I think you'll see more of a choppy Fed rate cut play in 2025 and then stop. One aspect to the Fed policy, that I don't want to spend an overtly amount of time with, though, is I wouldn't be surprised if they end QT altogether, quantitative tightening.
Right.
To me, that would probably make some sense given where we are in that process. And rates stay normal, but at these levels that people would consider now to be elevated. I would say they're more normal. So if you look at a 10-year treasury at 4.5, does that represent equilibrium value? It's a great case to make. How do you make that case? Back to what you said before, bonds are math. So say the real rate, a 10-year tip, say they stay around 2%. You're at 192 right now. And you think inflation is 2.5. 2 plus 2.5 is 4.5. That's how you get there.
Yep.
So to me, a 4.5 equilibrium level on the 10-year is a reasonable case scenario as well. Is it 4 to 4.5? Is it 4.5 to 5? Is it 4.25 to 4.75? The technicals seem to show it's more like a 4 to 4.75 kind of a range. But we've abrogated that specifically to the downside a couple of times in the last 12 months. To me, unless the economic numbers lead you there, if you get a 3 handle on the 10-year, that's when I think you short up on duration and you stop this should I go long duration um, part of the decision making process. So that would be the overall outlook, I think, and how you play it to me is the continued barbell, the treasury floating rate notes, the core duration, add a plus component, whether it's on the mortgage back side, could be alt credit in there. And I think maybe too, you want to take an active passive approach, right? That in the environment we're in right now, that, maybe you have something that's, I would consider treasury floating rate notes to be more on the passive side. Maybe that core could be something that you fill active fixed income that you can do um, with ETFs as well. So that would be the way that I think I would focus my positioning in fixed income based upon our outlook.
Gotcha. So one thing I just want to finish up with, if we see a couple cuts next year, um, that gets us to let's say 3.5, right, on Fed funds, maybe 3 and 3/4. Um, what's next after that, right? I know you've mentioned a couple times that this is sort of the old new normal. Um, but what comes after that, right? If inflation drops below 2, uh, economy still stays in good shape, corporate earnings still come in nicely, right? Unemployment's still in a good spot. Everything's going well, and we see that inflation number just continue to slowly come down. do you think, and I know it's really, really hard to predict what could happen this far out, um, but do you see them, you know, going back to cutting rates in accordance with that inflation print coming down? Like how do you view the, I guess you can call it intermediate, right? Maybe, a year and a half, 2 years out from now. Um, do you still see us in this sort of range that far out from now? What's your viewpoint on that?
Crystal ball gets real hazy after 12 months, let alone
It
6 months.
it does, yeah.
I would, what I would say in the environment that you mentioned, labor market's okay, economy okay, inflation continues to fall. There's no urgency for the Fed to continue to cut rates. So, you know, for them, the question becomes, and not just for them, for all of us, what is the neutral rate? And you're beginning to hear more of that conversation, the neutral rate for Fed funds. It's certainly what I think the Fed has it at 2.9 right now. It's certainly higher than that. So let's just say, for argument's sake, it's somewhere around between 350 or 4. Let's call it 375. Well, that's just a couple more rate cuts before you get there. Actually, it would be 3 rate cuts, I believe, to get there. One in December, two next year, and then that's it. Then the Fed can just sit back and let things go from there and see whether or not more is needed, or do they begin raising rates again? Who knows, right? If you get any surprises on the inflation side of the equation. But I think the Fed wants to get to neutral. It may take a little while for them to get there. And then the question is, what is, and that to me is going to be an interesting part of their summary of economic projections in a couple of weeks. Where is their new neutral rate? Did they make any changes from September? I would think that's something to watch going in 2024 5, because that will also make, I think, a big determination of what the Fed's going to do.
Yep. Do you, Kevin, do you buy into the idea that rates are stimulative for the economy? Um, in sort of a backwards way of looking at it, right? Because the consumers richer than ever before. You have a stock market at all time highs. You have home values, which are at all time highs. You have unemployment, which is really low. Um, People are making more money than they ever have, and they're getting paid for their money to sit in cash. Do you buy into the idea that that's in any way stimulative, and bringing rates down could actually make people spend less money because they're not earning as much on their cash? Um, does that have any? Do you buy into that whatsoever?
So I cut my teeth on the bond trading floor, um, and what you're talking about is kind of the other side of the trade, right? So that people, what they're looking at would be what is the offset or offshoot to what lower rates or higher rates. It's an interesting argument to make. What I would do is I like to watch national financial conditions, and the Fed Chicago. Here you go. It's for all your listeners out there, another indicator to take a look at. Not that it's a be all or end all, but it's pretty interesting.
Hmm.
If you were to look at the Chicago Fed National Financial Conditions Index right now, you are below or right at where we were. Actually, I think you're below. Yeah, where we're at from when the Fed started raising rates. Okay, so Fed raised rates 525 basis points,
Hmm.
and the financial conditions index, the Chicago one in particular, because it has, I think, over 100 or 105 components, which is what you want, right? You don't
Yep.
want to follow some of these indices that can be skewed by one or two numbers. It is visibly below where it was before the Fed started raising rates, and
Gotcha.
even with these rate cuts. So what does that mean when I say visibly below? Well, that means things are a lot looser than when they were, when the Fed began raising rates. So I think there's something to be said about that, and how you focus on whether lower rates or higher rates, just what kind of restraining or stimulative effect do they have. I think that's, I think there's more that plays into it, rather than, okay, I'm earning 5%, I'm going to go out and spend. Uh-oh, now my cash is only earning 3.5. Maybe I should
Right.
retrench.
Right. Very interesting. Very interesting. Awesome. So one thing I like to finish up with is, and this is something that I like to be, insightful yet, a little fun is, what's something that, throughout your career that has stuck with you? What's something that you've learned that stuck with you? What's something you've witnessed that has stuck with you? Any, a thought or belief that, that has, helped you, propel your career forward. Would love to hear, just a quick little thing about, something, something that, has stuck with you throughout your career.
The bond market is way smarter than I am. That's probably the one thing that would stand out, that, you'll have your good days and your bad days when you're making projections. What do you think the economy is going to do? The Fed, rates, spreads. The market can humble you very quickly.
Yep.
And you can't try to explain things away. Just look at what occurred, find out what had occurred, right? Everyone talks about, can you give me an attribution report? Well, give yourself an attribution report and say, what did I get right? What did I get wrong? And why? And then you move on and you move forward from there. And that way you don't get wedded and make any kind of mistake or a wrong call get amplified in the process. It's like when you look at the market, let's just put it in market parlance. You either go long position or short position, right? And your positioning, if at some point it's not working, when do you say, okay, that's it? I got to get out of this short. I got to get out of this long. The more you wait, the potential is for, more risk going forward. And I think that's from being in a strategy role, you need to look at things. From a market investment role, that's a little bit different, right? I was looking at it from a trading room environment. If you're a strategic investor, of course you can ride things out, and you don't want to make big moves one way or the other. But, from a more tactical perspective, when you're looking at it from that vantage point, it's say, okay, I mean, let's just say, for argument's sake, the last couple of years you called for a recession and it didn't happen. Give it up. Okay. Why? All right. We're not going into a recession. Don't try to explain it away, because I think what happens is you lose credibility in the process.
Right. Right. Hey, they do say, the bond market is the smart money. So it's funny that you said that. And, I think that's a great point.
I was hoping you'd make that point, Michael.
It's true. It's true. Look, if just watch price action. Watch what yields have done. It's kind of hard to deny that, I think, in my opinion, personally. Awesome, Kevin. Thank you so much. This has been great. Loved having you on. We'll definitely do this again. Maybe this time next year we'll jump on again and basically rehash some of the same stuff we talked about, and do our touch on what 2026 might look like. I know it's like you said, anything past 6 to 12 months, it's up in the air. So we really have no clue what anything might look at past then. But as of right now, everything's in my opinion going in the right direction. So greatly appreciate you taking the time, and it was great to speak with you.
Thanks for having me. Appreciate it.
Of course. All right. Bye, everybody. Sharpe Minds is produced and hosted by Michael Lafata, directed and edited by Alex Weimer. Our music is made by Tony Sapiano and licensed through Soundstripe. Michael Lafata, Financial Advisor at Archstone Financial. 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks, LLC, member FINRA, SIPC, a broker-dealer and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary of nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable, however, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated or registered with Cetera Advisor Networks, LLC. Any information provided by them is in no way related to Cetera Advisor Networks, LLC, or its registered representatives.